Hello everyone, this is Vinod Prajapati. In this video, we'll review the important announcements presented in the Union Budget 2023 for the general public and how should you manage your investments. We'll also look at the changes in interest rate outlook and review its impact on your equity investments, debt investments, and on your loans. This budget is intended to address the aspirations of all groups of society, including the poor, middle class, farmers, and entrepreneurs, among others. The budget maintains an emphasis on capital expenditure as the engine of development while simultaneously paying attention to the fiscal reduction. By not altering the way capital gains taxes are structured, it provides stability for the market. This was a modestly positive for equity market. A consistent key positive for the economy is that the government has been trying to focus on productive spendings within the constraints of resources. From an equity market perspective, it was a good budget. It has focus on both investments and consumptions. The infrastructure sector has continued to be on the lead to ramp up investment for the third year in a row, and the budget sounded modestly positive for automobiles, real estate, cement, and consumer staples. The budget will have a detrimental impact on the insurance sector as individuals' taxable income slabs have moved upward. Thus, comparatively fewer individuals will be required to invest in tax saving options. On the other hand, tax incentive has been removed for investing a large amount in traditional insurance policies. That is, premium of Rs 5 lakh and more in aggregate terms. As our focus is personal finance, we'll look at the budget announcement specific to the general public. Multiple changes were proposed under the new tax regime. For the benefit of lower and middle class, the threshold for taxable income increased from Rs 5 lakh to 7 lakh in the new tax regime. For HNIs, the surcharge rate on the income above Rs 5 crore is to be reduced from 37% to 25% under the new tax regime. This will result in a reduction of maximum tax rate to 39% from 42.7%. Further, there is an announcement to extend the benefit of the standard deduction to the new tax regime for the salaried class and pensioners. Also, the tax exemption limit has been increased to Rs 25 lakh from the current limit of Rs 3 lakh on leave encashments on retirement for non-government salaried employees. The Finance Minister has also proposed to reduce the number of tax slabs from 7 to 5. Let's look at the comparison of old tax regime and new tax regime. If someone's income is Rs 10 lakh, his taxable income would be around 7.25 lakhs only after all the deductions and exemptions allowed under the old tax regime. Here we have considered deductions of Rs 1.50 lakhs under Section 80C, Rs 50,000 under Section 80C CD, Rs 50,000 for standard deductions, and Rs 25,000 for Section 80D. Therefore, if your income is Rs 10 lakh, then you would be paying a tax of 57,500 under the old tax regime. However, by shifting your taxation rules as per the new tax regime, you will be paying only Rs 52,500. This is approx 9% savings in tax payable amount. This tax saving percentage reduces as we look at the difference between the old tax and the new tax regime for higher incomes. For the general public with a lower income, we believe that the budget has given substantial direct tax advantages under the new tax regime, which will raise their disposable income and encourage spending. Now, we believe that the focus of investor will shortly move back to two key factors, that is the corporate earnings and the cost of capital. We think that both these factors are neutral to negative for us from the near-term perspective, and thus the equity market may continue to consolidate till we get visibility on earning upgrades or a substantial decline in interest rates globally. Before we move forward, if you have not subscribed to our channel, I would request you to subscribe to our channel for regular updates on financial products and events that impact our financial life. Until May 2022, we were living in an easy monetary policy, which means interest rates were comfortably low. Then, as economies across the world reopened, we experienced a spurt in demand and disruption in supply chain due to the ongoing trade war between the USA and China, and the war between Russia and Ukraine impacted the supply of various essential items, example fertilizers, wheat, energy, etc. This resulted in inflation going over the roof in Western countries. And to bring down inflation to a comfortable level again, countries started raising their policy rates. In India too, the inflation rate went above the RBI's comfort zone, which resulted in Monetary Policy Committee raising the repo rate back to back from 4% to 6.25% within 6 months. The repo rate works as a benchmark for banks and NBFCs to decide on deposits and lending rates. Also, the government bond yield tracks the movement of repo rate. You would notice here that the bond yields is not moving in the same proportion. This is because they are tradable in the secondary market and thus reflect investors' emotion and sentiments. Now that we have understood the background, let's review the impact of interest rate hike on equity investments. In January 2022, Sensex was around 60,000 level. After a year, today also, Sensex is around the same level if we ignore the sell-offs in the last few sessions. Whether you are an investor in stocks or mutual funds, you would have made a muted or similar return in 2022 because the underlying asset is the same. When we invest in stocks or equity mutual funds, we invest in companies and their capabilities to make profit in future. Multiple factors, example changes in government policies, the income of consumers, political changes, changes in the corporate tax rate, etc., affect the company's day-to-day functioning. Similarly, the inflation rate, which forces interest rate movement, also affect the finances of these companies. For companies, a higher interest rate results in a higher cost of production, which means margin contraction and lower profit. Further, it leads to a downward revision of future projection, and thus we as investors seek lower prices for stocks, and that leads to a correction in stock prices. At the same time, weathering the risk, we also restructure our investment portfolio with a higher allocation to fixed income. This results in lower demand for equity and thus prices correct. Despite interest rate hikes, exits from foreign investors at a scale not seen in history, and premium valuation, if our equity market has not fallen, then that is only because of optimism from retail and domestic institutions. Thus, keeping in mind these economic developments along with geopolitical tension, we believe maintaining an underweight or neutral position in equities as per your risk profile or strategic asset allocation is more prudent at present. Just to brief you on the equity market valuation, this chart shows that the market cap to GDP ratio is near an all-time high. The market cap to GDP ratio, which is also known as the Buffett indicator, is a ratio used to determine whether an overall market is undervalued or overvalued compared to a historical average. At an estimate of 104 against the average of 81, our overall market is overvalued by 28%. Look at this chart. Imagine you have a large amount and looking for investment opportunities. Won't you think twice before investing in the Indian equity market or not selecting the emerging equity market, which is trading at around 30% cheaper than its averages and approximately 60% cheaper than the Indian equity market? I know that the Indian equity market generally trades at a premium as compared to the emerging equity market. But currently, this premium is at 132% against the last 10 years average, of which is just 67%. That is almost 200% premium. The large difference in valuation is visible due to the Indian equity market's outperformance during the post-pandemic period. Thus, further upside from here on will be a function of stability in the global and local macros and continued earning delivery by the corporates. I hope my point is clear. Do let me know your thoughts in the comment. Now, let's review the impact on debt investments, but before that, let me show you something interesting. Looking at this chart, many of us will say spontaneously that the chart shows outperformance of Nifty index over the bond fund return, which is obvious. But when you look at it closely, you'll realize that from 1st Jan 2013 till 8th October 2020, that is about 8 years, the difference in performance of Nifty index and this dynamic bond fund is not significant. Also, from the chart, you can understand that there have been periods of outperformance and underperformance by the Nifty index by a thin margin. So, I'm trying to give a message here that debt funds or bonds are very important and thus should be part of your investment portfolio. With this, let's look at the impact of interest rate hikes on your debt investments in detail. For fixed deposit investors, there will be no impact as their pre-booked FDs will continue generating interest income at the rate of interest they were booked at. Of course, investors will have the option to break the earlier FDs and rebook at the revised FD interest rates. I would suggest you to review whether you are earning an excess amount in the new FD considering the loss of interest income and penalty for breaking the existing FD. Otherwise, you should continue with the existing deposits. For fresh investors, clearly there is an opportunity to invest at the current interest rate. Investors in bond or debt funds would have made a muted return in last year because of the inverse relationship between the bond prices and interest rate movement. Let me explain this. When interest rate move higher than the interest rate that was prevailing at the time of investment in the bond, then the investor would experience a fall in bond prices. That is because the new bonds are likely to be issued at a higher coupon rate as interest rates have increased, making the old or outstanding bond generally less attractive without adjusting the price at a lower level. So higher interest rates mean a fall in the prices for existing bonds and capital loss for existing bond investor. However, the current bond yields are very attractive for fresh investments. Before investing in the debt fund or bonds, investors should pay attention to the modified duration of the fund, yield to maturity, the average duration of the fund, and the credit quality. The modified duration of the fund guides the sensitivity of the fund to interest rate changes. Higher the modified duration, the higher the sensitivity. Ideally, one should invest in a lower modified duration fund in a rising interest rate scenario and should invest in a higher modified duration fund in a falling interest rate scenario to benefit from the inverse relationship between the bond prices and interest rate movement. To keep the video short and to the point, I would suggest you to learn on your own about the other three important characteristics of the debt funds. However, if you can't learn it, then do let me know in your comment below so I can explain it to you by answering your comments. Now, let's quickly look at the impact on home loan borrowers. Because home loans are for a long tenure, adverse movement of interest rate by a small amount also impacts big on EMIs. Home loan borrowers typically have two options when interest rate rises. They can either accept a higher tenure or a higher EMI. Home loan providers by default increase the tenure. You can understand the problem for home loan borrowers by knowing that a 20-year home loan has become a 32-year home loan due to changes in interest rate. I think the only option that remained with the home loan borrowers is to consider prepayment of their loans. However, if they want to maintain liquidity, a home loan with an overdraft facility makes sense. I have already published a video discussing the impact of an interest rate rise on home loan borrowers and how shifting to a home loan with an overdraft facility can help them in reducing the burden. I am giving you a link of the same video in the description. If you're liking our video content, then do subscribe to our channel and share it with your friends and relatives.